What's up, traders and investors? Welcome to TradersArmy.com. This is our web series on options foundations. What is an option anyway? Before we jump right in, I want you guys to know that anytime you want to reach out to us, and if you have any questions for us about this web series or any other web series for that matter, or anything that you would like to see more of here at TradersArmy.com, feel free to reach out to us. Support at TradersArmy.com is our direct mail. So anytime you guys have any questions, please let us know. Diving right into options, what is an option anyway? Well, an option is simply a contract between two parties, one buyer, one seller, that offers the buyer the right but not the obligation to either buy or sell the underlying security at a specific price. When we talk about the underlying security, we mean the underlying stock. It could be a futures contract. It could be a number of different financial products. That's known as the underlying. This allows you to either buy or sell the underlying at a specific price, also known as the strike price, on or before a specific date in time, known as the expiration date of the contract. The seller of that option would then be obligated to deliver or purchase the underlying if the buyer exercises their rights associated with the contract. The buyer will always have to pay a premium to the seller in every transaction. The premium, just as a side note, will always be referenced in an option market as a per share value. Advantages of options trading versus stock trading. Some of you guys out there may have also already been involved in buying and selling securities, stocks, mutual funds, things like that, ETFs. But some advantages over stock trading would be, number one, you can start with a smaller account. You don't have to have very much money at all to start trading some of the option strategies that we're going to go through in this web series. Not this particular episode, but other web series down the road when we get into actually trading options. You can trade within all account types. Now, this is going to be broker specific. In a different web series, we're going to talk about what it means to choose the right broker for your trading and investing. This is going to involve making sure that you choose a broker that allows you to use options in all of your accounts. The government allows us to use options in all of our trading accounts, our margin accounts, our non-margin accounts, IRAs, SEP IRAs. Even some 401ks will allow some very simple options investing for typically hedging or offsetting risk to some underlying security and an adverse move in that security. Options are going to be really, really great for generating active short-term income and passive long-term income, and protecting that long-term wealth using hedging strategies and different types of options will offer that protection so that we can sleep overnight, just like protecting our home, our autos, our lives, etc. Stock replacement. So there's going to be a reason to own stocks at the right time. You know, some of you guys like to own stocks because they may pay a dividend, or you just like to say, I have ownership in XYZ stock. Okay. At some point in time, there's going to be a time where stocks have just become way too expensive, way too overpriced for us to invest in, and quite frankly, outside of some people's actual financial reach. So we can use options as a way to replace the stock, being able to take advantage of the movement that we would expect from owning the stock without actually having to own the stock outright. Obtain dynamic leverage with limited and oftentimes defined risk. So we'll show you how you can get unlimited profit potential with limited downside risk if the market moves against you, and can be used for all market environments. This is going to be an important one because trading stocks, trading trading futures, trading Forex, all require us to be directionally right, correct on our outlook for us to make money. And if we're directionally wrong on our outlook, well, we start to get into a losing position right away. While there are some strategies and options that allow us to make money on upward trending markets, downward trending markets, explosive markets, one way or the other, using bi-directional trading strategies, also neutral range-bound markets. For the sideways market, we can generate some pretty passive income and some pretty great income, as you'll see in future web series here at TradersArmy.com. Making it really convenient to use for all market environments. And the commissions are very low. Again, very broker specific. Some brokers will want to charge more money. Some brokers will charge less. We'll get to choosing the right broker in another web series. Now, can anyone trade options? The short answer is yes. However, your broker must approve you, and there are up to 5 levels of authority. Again, broker specific, which would allow you to trade all option strategies if you are approved. Now, it doesn't take much to get approved to invest in options or use options, but right out of the gate, they're going to give everybody level 1 and typically level 2 options trading strategies, which would generally allow us to basically use options as a way to protect a stock position. These are known as protective puts or married puts. Also allow us to generate income by selling call options against stock that we currently own. Those are called covered calls, also known as buy right opportunities. Now, level 2 will allow us to buy calls and puts. It's also known as going long calls and puts. And we could sell short cash secured puts. Those are very simple strategies, pretty easy to get level 1 and level 2 within most every brokerage account. Now, once you get up into level 3, we can start to spread trade using multiple option legs. Level 4 allows us to short naked or uncovered options, and level 5, if applicable to your broker, will allow you to sell naked or uncovered index options, which carry typically the highest risk for the broker if the trader or investor doesn't know what they're doing, which is why they put it at the highest level. These are not levels of authority meant to protect you. These are levels of authority meant to protect your broker from you not knowing what you're doing. Having an uneducated, unskilled investor could cost the broker a lot of money. So they put these limitations on us if we can't, if we don't say that we have some sort of experience or knowledge about the different strategies that fall within those different levels. Now, moving on to specific contract specifications and characteristics. Number one, when I mentioned that the options chain, the options market itself would quote options prices and premiums in per share increments, it's important to know that one contract is equal to 100 shares of the underlying. The strike price is defined at the exchange price of the underlying. This is where we agree in the financial contract where we're going to exchange the underlying security, meaning a price. The expiration date is the date at which the option can no longer be used, and typically, at least going back into the early days of options back in the 1970s, up until just a few years ago, most of the expiration dates would fall on a monthly or quarterly schedule. But since options started to become a lot more popular and a lot more liquid over the last several years, a series of options known as weekly options have been listed, and so a lot of these options that we'll be able to trade on very liquid stocks and exchange traded funds will have plenty of different expiration dates for us to choose from when customizing our option strategies. Every single day, this is important to note, every single day that an option is listed and getting closer and closer and closer to the expiration date, the options value will decay as time passes. And we'll talk about this time decay a little bit later. Premium. The premium is broken up into two parts. Now, you can have some intrinsic value, and I'll talk about what intrinsic value really is and how we know whether our option has intrinsic value or not, but this is also referred to as the real equity in the option. And we also have extrinsic value, commonly referred to as time value, but we don't call this time value because it includes some other factors as well. When interest rates are rising and falling, time value, the extrinsic value will be affected. As time is going by, extrinsic value will be affected. As the overall demand for the options pick up, or if there's too much supply for the options, too many sellers out there, then that will affect the extrinsic value. So these are just other factors that will affect the premium and help us to enhance our option position, and it will be important to understand these other factors so we can remove or at least hedge away the risk or be aware of the risk of time and interest rates and overall volatility of that particular market and how it's going to affect our position. So we are going to get into that. Now, there are two types of options. There are what are referred to as American style options and European style options. Really, the biggest difference is that American style options, these are all your stock options, ETF options, etc. These can be exercised and assigned anytime before expiration. So you might have a 3-month option position that you've either bought or sold, and you can exercise your rights if you're an owner of that option, or you could be assigned at any time before the expiration date. A European style option can only be exercised or assigned at the expiration date. So those are the two most important factors about the European versus American style options. Your European style options can oftentimes fall under your some of your futures options, some of your index options for the S&P 500, Russell 2000, Nasdaq, etc. But these are going to be a little bit less commonly used. I mean, I do know a lot of traders who do trade European style options on the indexes, but most are going to be using the American style options on your stocks and your ETFs. Now, just to kind of use from an analogy perspective, so we understand what an option contract really is, I want to explain using an analogy. So analogies work well because a lot of times we use these different types of products in our everyday life and we don't even know it. So options are going to work in almost identical ways as insurance policies. An insurance policy on your home, for instance. If you're a homeowner, you're going to carry an insurance policy that you've purchased from an insurance salesperson. The insurance buyer pays the insurance company, also known as the seller or writer, a premium in exchange for a contract, also known as a policy, which can be exercised, or we can make a claim, if you will, at any time between the date issued until the expiration date of the contract. If the holder wants to make a claim, the insurance company is obligated to fulfill the terms of the contract, and the terms of the contract are going to be built in all the way out till expiration, meaning total replacement value of the house or whatever the damage is to the house during the time of the contract. If the holder of the contract does not use their contract by expiration, the policy expires worthless and the insurance company keeps the premium. Let's look at an example here. In order for this homeowner to protect the investment in the house from fire, flood, etc., the homeowner needs to purchase an insurance contract for the replacement value if damaged or destroyed. So the homeowner currently has the house. They purchase a contract. This is the insurance policy. The expiration date typically runs in 6 to 12 month periods of time. This one will be 12 months for example purposes. The premium, let's call it $5,000. Replacement value, $400,000. Now, I'm just using arbitrary numbers at this point just to prove a point here. Now, homeowner and insurance contract buyer on the left, insurance contract seller or writer on the right. What happens? Well, the payer or the buyer of the contract pays a premium to the seller in exchange for a contract. Okay, now the seller writes the contract. All the terms are in the contract. The buyer now receives the contract and has the right to make a claim and collect money up to the insured value for a limited period of time. The homeowner has the right to make a claim for the full amount of the contract for the damages if the house is completely destroyed. And the contract seller would then have an obligation to pay premium, also known as the damages, up to the full amount for the coverage of the damages if the buyer exercises their contract. So here's some possible scenarios. The house is completely destroyed and the homeowner exercises their contract. The seller of the contract pays the replacement value to the homeowner. Full value, the homeowner can rebuild their house however they see fit on that property. Possible scenario number 2, only the kitchen, for instance, has burned down, creating $50,000 worth of damage on this $400,000 home. The damages are paid out to the homeowner by the seller of the contract, and now the homeowner can rebuild their kitchen for the replaced dollars coming from the insurance seller. Now, what happens if it's damaged? Well, they get the full replacement value. Now, the underlying in this scenario is the house. Okay, if the house is damaged, all the damages, the value of the damages, are actually built into the contract. Now, what if no damage has happened at all, and one whole year has gone by, and the homeowner does not want to use or doesn't need to use their contract? Well, what happens is the contract expires worthless to the buyer. The seller has earned their right to keep the premium. Understand that when the insurance salesman sold the contract to the buying party, all they did was receive their premium in exchange for the contract. But they have not earned that premium, earned the right to keep that premium until they've waited out the entire life of that contract to see if the buyer was essentially going to call them up and exercise their claim, exercise their rights. So each day that goes by, the seller of that contract is in fact earning their premium. An example of that would be if you bought the contract, it had 12 months worth of time. Nothing happened to the house in the first 4 months of its life. The seller decided to, the buyer of the home decided to sell their house, and they still have 8 months worth of time left in their insurance contract. Well, if that 8 months worth of time is unused, the owner of the contract calls their insurance agent and says, hey, I don't need my contract anymore. This is going to allow them to get some prorated money back for the premium that they did not use. So the insurance company has to give back a check for a partial amount, not the whole amount. In a sense, they've earned 4 months of that premium by allowing them to maintain ownership of that contract for those 4 months. That is how an insurance policy works. That is a contract between a willing buyer and a willing seller of that contract to insure an underlying known as the home. Now, as we take this into the options market, we're going to talk about just how similar that works when dealing with call options and put options. Here we go. Now, first we need to understand that there are only two types of options. There are call options and put options. There are sides that you could take, meaning you could be the buyer of the call option or the put option. You could also be the seller of the call option or the put option. And there will be reasons that we're going to discuss later as we get deeper into options characteristics, why you would want to be a buyer and why you would want to be a seller. And in some cases, we may want to be both, which is going to be referred to as spread trading the options to minimize risk to the overall market moving and factors that might work against us. Now, the terms of the contract, I know this is a lot of words, and we're going to be operating off of this grid quite a bit, but I have some analogies and some scenarios that will help us actually understand the relationship between call buyers, call sellers, and put sellers. Now, the call definition, the contract terms are this. If someone buys a call option, they have the right to buy the underlying at a specific price on or before a specific date. It would be utilized in the event that they thought they wanted to buy the stock and they were bullish or needed the stock to go up in price, but instead of actually buying the stock outright, they're going to purchase a call, which is the surrogate. It's the right to buy the stock at a set price. If the stock price goes up in the future, their right to buy at the current price or at a fixed price is more valuable. Now, the seller of that call option would be obligated to deliver the underlying security to the call option buyer if they exercise their rights at that specific price on or before a specific date. This person's outlook is more neutral. They do not think the market is going to go up like the opposing call buyer. They believe the market's going to remain neutral or actually go down, which is another word for bearish. Bearish is another word for going down. So one person thinks the market will go up. The other person thinks the market will stay the same or go down. That's call options. Now the put options are the exact opposite in terms of the outlook. So the buyer of the put option is going to pay a premium to the seller. The buyer would then have the right to sell the underlying security at a specific price on or before a specific date. They could just sell the stock outright, but they're not interested in selling the stock outright. Maybe they don't want to sell the stock that they currently own, or maybe they don't want to short the stock because it requires too much upfront capital. So instead of outright selling the stock due to their bearish outlook, they're going to purchase the right to sell that stock at today's prices. In the event that the stock falls in value, they will still have the right to sell that stock at the previously determined value, ideally higher for this person at a higher price, as long as it happens before the expiration date. Now, the person or trader who sold them this put option is under the obligation to purchase that underlying stock from them at a specific price on or before a specific date. So this person does not believe the market price will go down. This person believes the market will remain neutral in price or potentially even go up in price. But if the market price falls, like the buyer thinks it will, then the seller would be under obligation to purchase the stock from the seller of the stock because they agreed upon that in the terms of the option contract. Now, I realize that because we're just going through words and definitions at this point, that you may not be totally clear on how all of this works, but we are going to get to that as we get into some analogies with this. Now, an important note, what does my option settle in? Understand that when someone opens up a contract, a willing buyer and a seller, there's got to be a settlement period of time, that's your expiration date, and the option has to settle in something. And so what most of us are going to be trading are stock and ETF options. So at expiration, all the options that are currently still open have to be settled. The ones that actually have value will settle in underlying stock, meaning the stock or ETF will actually transfer accounts. If you are trading index options, those will settle in cash because you can't actually own the index. It'll just settle in the cash difference. If you're in a losing position, the cash will come out of your account and go into the winning party's account. If you're trading futures options, typically this is going to actually settle in the underlying futures contract. So we're not going to start out trading options on futures, but just know that all the concepts and techniques that we're talking about trading options with, these are also going to apply to trading futures and currency options down the road as well. It's very important that if you are uncertain about your contract specifications and components and how they work specifically or what they might settle in, it's important that you know that before you get into the trade. Now, if you want to know the full contract specs and components, I urge you to go to the cboe.com/products page, and the Chicago Board of Options Exchange will actually give you a list of all the stock and ETF and index and futures and currency options and talk very specifically about components and the specifications of those contracts. Now, like I said earlier, we only have 4 possible actions or combinations. If we buy to open or sell to open a contract, then we would turn around and sell to close or buy to close that contract. So if you buy to open, you paid the premium. If you sell to close that contract, you'll receive some money back. Now, if you sell to open a contract, to get out of it, you must then turn around and buy to close that contract. And whether you made or lost money in that position would determine whether or not you were able to buy to open at one price and sell to open at a higher price. If you bought at one price and sold at a higher price down the road, you made money. If you bought at one price and sold at a lesser price down the road, you lost money. And if you bought and sold for about the same price, you broke even, less commissions. If you sell to open a position, this means that in the future you believe you will be able to buy to close this option position back for less than you originally sold it for. But if you sell to open and have to buy to close for a more expensive price, you lost money in that position. Now, let's take a house example. Let's go back to a house for a second. And now this is not an insurance position like we talked about in the previous web series. This is just a whole different scenario where we're going to use some names, use some prices, and this is a contract on the house. So this is an example, an analogy where the underlying is a house, not a stock. So Larry wants to buy a home. Okay, Larry is in the area, but not yet. He needs to make sure that he can find some work in the area. Larry needs to secure some funding for this house. So he doesn't use his own capital. So instead of outright buying the home today, he buys an option on the home. Now, who can sell him the option on the home? Well, the homeowner can sell him the option on the home. That is it. The homeowner can sell him an option on the home. Now, why would the homeowner want to do this? Well, the homeowner may have been sitting on this house. It's been listed on the market for several months. It's not moving. No one has, come by and checked it out. Larry is an interested buyer and says, hey, I want to buy your home, but I have to walk away from the property at this point to go find funding and also make sure I can get work in the area, maybe bring my family by, just to make sure that everything looks good on the house, get the inspection, all that stuff. So Larry says, well, if I walk away right now, I risk somebody else coming along and actually purchasing the home out from under me. And I love this home so much, I want it. I just have some things to get taken care of. So knowing that the homeowner is not just going to pull the for sale sign and agree to sell the house to Larry if Larry comes back at some point, Larry decides, hey, listen, if I pay you some money, I'll write you a check right now for $4,000. Could you pull the house off the market, not sell it to anybody else, and only agree to sell it to me? This is Larry talking. If I come back within the next 3 months and I have secured funding and I found work and I want to buy your house, this premium or this $4,000 that I'll pay you right now gets me a contract that really only allows me to do one thing. This contract will allow Larry to purchase this house for $400,000 anytime between the next 3 months, now and the next 3 months, in exchange for Larry paying the homeowner $4,000 right now. So what happens if somebody comes along and they want to buy the house within the next 3 months and they want to buy it for 400,000, 450, 500,000? The homeowner cannot sell them that house because they are currently under contract with Larry. So Larry has locked in that he is guaranteed to be able to buy this house between the next 3 months, now in the next 3 months, for $400,000 guaranteed because he paid the homeowner a premium securing this contract. Now, let's go through a couple scenarios here. Larry, aka the option buyer on the left, buys the contract by paying the homeowner a premium. The homeowner then writes the contract, gives it to Larry, and now Larry has this contract. Now, what does Larry have the right to do? Larry has the right to buy the house for a limited period of time. For how much money? Larry has the right to buy the house for $400,000. Now, what if he doesn't exercise his rights? Well, if he doesn't exercise his rights, the only thing he loses is what? The $4,000. If Larry exercises his rights, then he basically walks to the homeowner. He says, remember this contract you sold me? I'm going to exercise my right. I get to buy your house, and the homeowner has an obligation to sell him the house at the $400,000 fixed price, if and only if the buyer decides they want to exercise their contract within the next 3 months. So let's go through a couple of scenarios here. Number one, oil is discovered in the backyard bubbling up from the ground. Now, the house, which was originally appraising for $400,000, will no longer be appraising for $400,000 now that oil has been discovered in the backyard. And mind you, this has to have been discovered within 3 months for this to be a benefit to Larry. Larry is the contract owner, not the homeowner. The homeowner is under obligation to sell the house for $400,000 no matter what. So imagine you're the homeowner here and you just found oil in your backyard and you've got a contract to sell your house for 400 grand. Are you happy about this discovery? No, you are not, right? Had you had discovered this and you did not have a contract out on this house, you could essentially sell your house for about $1 million right now because that's what it's appraising for, okay? The home's appraising for about $1 million. Larry's contract has now increased in value to at least the difference between $400,000 and $1 million. Why is that? Well, think about this. Larry has the right to buy the house for $400,000. If he exercises his rights, he could turn around and sell the house for $1 million and make a $600,000 profit on the house. Now, would it be a good idea, this is just food for thought, would it be a good idea for Larry to exercise his rights, purchase the house for $400,000, keep the house, or just turn around and sell the house for $1 million down the road? He could do that because he's the homeowner if he exercises his rights. Keeping in mind, he has to come up with the $400,000 to actually purchase the house. So that's one option. The other thing he could do is try and find a buyer for this contract. Larry could actually sell this contract for its increased value to somebody else who may want to purchase the house, or who may want to speculate even more that more oil will be found or other valuable resources may be found on this property. Heck, you could even have multiple buyers for this contract, and there could be a bidding war for this contract that Larry has secured just a couple months earlier. So Larry could either exercise his rights or just sell the contract outright for its new higher value. And the value of this contract is at least trading for $600,000. Why? It's the difference between where Larry has the right to exercise and the current appraised value for the property. I'll let you think on that for a second. Which would make more sense? Exercise his rights or just sell the contract to another party? My vote, our vote, sell the contract to another willing party and get out of the whole position altogether. Why? Well, you're not going to make any more money by exercising your rights, buying the house, and taking ownership of the house. You're not going to make any more money. You could still sell the contract today for $600,000, so sell the contract for $600,000. The return on investment is much greater when you paid $4,000 for something that's now worth $600,000 and you just sell it outright and realize your $596,000 profit on a $4,000 investment. If you exercised your rights, you'd have to come up with a $400,000, and you can still only turn around and sell the house for $600,000. So yes, you would make almost $600,000 in profit, but you'd have to come up with $400,000 in the meantime to purchase it. Now, what if in the meantime something very negative happens to the house and you're the owner of the house? You lost all the opportunity to sell the house for $1 million if something happens to the house in the meantime. If you just went out, as I suggested, if you just went right out and sold the contract, never even took ownership of the house, you never carry risk of owning the house, you never have to put up the capital to own the house, but you still get all the upside advantages of the home being worth more in value in the future, as long as it happens within a 3-month period of time. Okay. Now, what if during the 3 months there was no oil found, there was actually nuclear waste found on property? This is bad. Bad for who? Well, it's bad for the homeowner. The homeowner has a property that used to be worth $400,000, but because of this discovery is now only appraising at $100,000. Larry's contract has no real value, but Larry can only lose what he paid for the option. This is known as the premium. He paid $4,000 in premium. If Larry does not want to purchase the house, he doesn't have to. Therefore, he just loses the $4,000 in premium. And if he still wants the house for whatever reason, he can get the house for significantly cheaper than $400,000. So he could still approach the homeowner and say, yeah, I want to buy the house. I'll pay you $100,000 for it and clean this mess up myself. But the risk is only $4,000 to the contract holder. So the moral of this story here, of this analogy, is when we purchased the contract, or when Larry purchased the contract, Larry had unlimited profit potential if the home went up in value during the contract life, but limited risk potential, that's the premium paid, during the contract life, and that was just the $4,000 that Larry paid the homeowner. So how does this work when we're not talking about home, but we're talking about stock? So here on the left, we have a call option buyer. We'll talk about their motivation in a second. On the right, we have a call option seller. The call option seller may own 100 shares of that stock, and we need to own 100 share increments to do so. But here's the deal. The call option buyer steps in and says, hey, I think that stock is going up. I want to pay you a premium in exchange for a contract. So the buyer pays the premium to the seller of the call option. The seller of the call option writes the contract and agrees to this contract term. So now that the call option buyer owns this contract, what do they have the right to do? The party on the left has the right to buy 100 shares of the stock from the party on the right at a fixed price for a limited period of time. If he or she exercises their rights to buy the contract and buy the stock at a fixed price, then the person on the right has the obligation to deliver that stock at a fixed price if the buyer exercises their contract. So let's take, for example purposes, XYZ company is currently trading at $50 per share. So this is going to represent 100 shares in every case because options are traded in 100 share increments. The investor does not currently own the stock, but believes the stock will go higher and likely reach $60 per share within the next 3 months. However, if he or she does not want to pay the cost of ownership, what can they do? Well, they can buy a contract on that stock. Now, in this case, hypothetically speaking, we're going to go out and buy a call option with a 6-month expiration. And the 6-month expiration is going to be the amount of time that this person has to achieve the profit target on this stock. So the profit target is $60 per share. Current price is $50 per share. So the contract buyer or option trader says, I'm going to buy this contract. The strike price is $50 per share, which is right around today's current price. And the option market would charge $5 per share for that contract. So think about this. The premium is $5 per share. It's 100 shares. So the out-of-pocket cost to the contract buyer is $500. So what is the risk, okay, to the option buyer? The risk is the stock doesn't go up. The stock goes down. They were wrong in the trade. And the most they can lose is their $5 per share premium, totaling $500 per contract. Okay? But what if the stock does go up? What if the stock does go up to 60? Well, think about this. If the stock is at 60 and this contract gives the owner the right to buy the stock at 50, well, the real equity, or what I would like to call bragging rights in this particular contract, is at least $10. When I mean bragging rights, I mean this. If you're the owner of this contract and you can brag to your friends and family and say, hey, I've got the right to buy XYZ stock for $50 per share, even though it's trading for $60 a share today, you've got intrinsic value, also known as bragging rights. That's $10 worth of intrinsic value, so the option is at least worth $10. Now, on top of that, if there is any time left before the option expires, in this case, after 3 months of time has passed, well, the original time purchased was 6 months. So if we still have 3 months left worth of time, there's going to be some extrinsic value still left. So if you add the intrinsic value to the extrinsic value, this option on the open market would be trading for around $11.10. So what the investor bought for $5 can be sold for $11.10, totaling a little over 100% return on their investment. Pretty good deal on a $10 stock movement. Now, what if the stock stays sideways? It just stays at 50. Well, after 3 months, it has no intrinsic value. Everyone can buy the stock for 50. So can the contract owner. But since a little bit of time has passed, a little bit of the extrinsic value has gone away. But what they purchased for $5 is still worth around $4 at this time. So due to time decay eroding the value a bit over the last 3 months, they could still hold the option position for a little bit longer to see what happens, or sell the contract for a little bit of a loss, a $1 loss to be exact. So what if the stock goes down? Well, if the stock goes down to 40 or 30 or 20 or 10 or 0, the option has no intrinsic value because everybody on the planet could buy it for cheaper than your option contract could. So no intrinsic value there. The option's extrinsic value will be worth significantly less because, well, the likelihood that it's worth anything over the next 3 months is highly unlikely. Therefore, whatever the investor paid $5 for is now worth $1. Since the stock went down and time has passed, it's worth even less. Therefore, we could hold the position all the way out to expiration, risk the full $5, or close the position now and take a $4 loss. Now, we're not talking trading strategies here, but just giving you some concepts, some ideas of what causes options to be worth whatever they're worth in the future. So remember, a 6-month option purchase for $5 a share times 100 shares. What if the stock itself stayed at 50? Well, the intrinsic value is worth nothing. The extrinsic value is worth 410. Therefore, as an example, the premium value being worth 410, the option position lost a little under 1%, or little under 90 cents, little under a dollar, so about 90 cents in value. That's about 18% loss on our original investment. The stock, if you had just purchased the stock outright, we would have lost nothing. Okay. Now, that's a disadvantage in the option column because we actually lost a little value due to time going by. What if the stock price went up to 53? Well, the option's intrinsic value is worth $3. The extrinsic value is worth $3.50. The premium value totals $6.50 when you add those two up. Therefore, the option made a $1.50 profit, or 30% return on investment. The stock, if you had purchased it outright for 50, would have made you 6%. Okay, not bad. If the stock continues to go up in price, say to $56 or even $60 a share, what you'll notice here, when just forwarding over to the rate of return on the option position, notice how the rate of return quickly jumps from 30% up to 72%, up to 102% on small increases in the stock value. Notice how it jumps from 6 to 12 to 20% if you would just own the stock outright. The really unique thing about an options return on investment is that we have what we refer to as dynamic leverage, meaning when you are right in the trade and the stock moves in your favor, your rate of return goes up not in a linear fashion, but it goes up exponentially. And I'll explain why that occurs in a different web series coming up later. Stock, you pretty much have no dynamic leverage, no leverage whatsoever. The stock is going to go up dollar for dollar, penny for penny, and it is what it is. So if you made a 20% return on the stock investment, that's not bad if the stock went to 60. But would you rather have a 20% return on the stock or a 102% return on the option when talking about your capital itself and the use of your capital? I think all of us would agree that the better use of capital would be in the options trade, giving us a better return on investment. Now, let's say the stock goes down to 46, down to 40, down to 0. The stock goes to 0. Notice how the option's intrinsic value will always be 0 if the market is below your strike price. The time value or extrinsic value will depreciate as we get further away from the strike price and as time goes by. So when the premium value decreases, we lose money on the option. The return is increasingly getting worse, all the way down to a potential 100% loss on our option. But 100% loss on our option is still only $5, you guys. All right, so still a very small risk relative to the reward potential. Now, for the stock to lose 100% of its value, it has to go to 0. So herein lies a benefit for the stock over the option. You could hold on to a stock position for a very long time, forever, really, and if it goes nowhere, you don't lose anything. If it doesn't go to 0, you don't lose everything. The disadvantage of an option is that if you can't use it within your expiration period of time, in this case 6 months, well, it expires worthless and you cannot use it after its expiration date, so you would in fact lose the premium. Okay? Call option has unlimited profit potential but limited risk. Premium paid in this case $500 per contract because it's 100 shares. Stock position has unlimited profit potential but also the risk of the stock going to 0. In this case, the stock carries much more risk. Bullet point note here, summarize: options offer a better use of capital, better control of the risk while maintaining unlimited profit potential. Win-win-win for the options. Now the put option is pretty straightforward. We'll go through this and then we'll move on to the next web series on how to start valuing what these options are really worth and how to choose the right option. Put options buyer. Okay, so on the left here we got a put option buyer. Let's say, for instance, the put option buyer owns 100 shares of the stock. Now, what if they think the stock is going to go down? What could they do? They could just get rid of their stock and sell it on the open market. But what they would lose out on is, what if they're wrong and the stock price goes higher? If the stock price goes higher and they don't own the shares anymore, they don't have any profit potential. So what can they do to maintain upside profit potential while minimizing downside risk? Well, they could purchase a contract. A put option contract would require them to pay a premium, okay? And they pay that premium to the put option seller. The put option seller says, hey, sure, I'll write you that contract. And they deliver the contract to the put option buyer. And by the way, this all happens electronically. It's not like someone is actually walking over to someone's office, handing them a check for the premium, and then they physically write out a piece of paper, a contract, and hand it to the put option buyer. This is all done digitally, electronically, through our option exchanges and our market makers at our brokerage houses. So once the premium is paid, instantly the contract gets delivered. Now the put option buyer has the right to sell 100 shares of their stock per contract for a fixed price for a limited time. So this person has the right to exercise and sell their stock. If they do exercise and want to sell their stock, the party on the right has the obligation to buy that stock at a fixed price if the buyer exercises that right. And there could be lots of reasons why this put option seller wants to sell them this contract. Maybe they actually do want to buy that stock, and this person was just paid a premium for the obligation to buy the stock at a price they would want to buy it at anyway. So this could be a win-win for both parties. Okay, that can happen. So we'll discuss strategies and in further web series later on. So this person has the right to sell 100 shares to the person on the right. Now, let's say that the investor owns 100 shares of XYZ stock and they purchased it at $60 a share. So if the stock is currently trading for $100, they have a $40 per share profit and they want to hold the stock for an even longer term. But feels like the stock may drop soon, so what can he do to protect it? Buy the put option contract. So when this person buys the contract, they have to pay a premium. In this case, they pay a $6 per share premium, so that's $600. Now in this case, they're buying a 9-month expiration, so a 9-month put option at an exercise price or a strike price that is right at today's prices. So they're buying a 100 strike price option for $6 a share with 9 months to expiration. Let's talk about some what if scenarios. What if 4 months of the total 9 months has passed and the stock goes up to $120? Now, this does benefit the stock owner, right? Because they own the stock, and if the stock goes up in value, they make more money on the stock. But think about what this did to their option position that they just purchased 4 months ago. Well, the option does not have any intrinsic value. Think about the bragging rights of this option. This option says, I can sell the stock for $100 a share between now and expiration. If you were to tell your friends and family, hey, this XYZ stock currently trading for $120 per share, you guys know I have the right to sell it for $100. Do you have bragging rights? No, you don't. Your family would laugh at you. Your friends would laugh at you. You'd say, so what? Everybody can sell the stock for $120. You're not special being able to sell the stock for $100. Therefore, your intrinsic value has no real value. But since you still have about 5 months worth of time, you have some extrinsic value due to that remaining time. So what the investor bought for $6 can be sold for $1.30. But so while they've taken over, roughly a $5 loss on the option, they've made $20 worth of additional profit on the stock, which well pays for the money they lost on the option position. So they're still in an overall net profitable position. Now, what if the stock just went sideways? Well, if the stock stays at 100, they haven't lost anything on the stock, but they have lost some time decay on the option. Option's intrinsic value is at 0 because everybody can sell the stock for 100. The option's extrinsic or time value is at $4 still because there's still 5 months worth of time. Due to the time decay, they still lost about $2. So if they wanted to hold on to the option position, they could. This would protect them if the stock if the stock drops over the next 5 months, because they still have 5 months worth of time left. Or they could just sell the option outright and take a $2 loss on the option while maintaining all their profit potential on the stock. Now, what if the stock actually goes down? This is the very scenario they were worried about. If the stock goes down to 60, okay, they've lost $40 worth of value in their stock position because they have a $100 stock now that's now worth 60. So they lost $40 on the stock. However, check out their bragging rights on this option. Now, if you were to tell your friends and family, hey, the stock is currently trading at 60, but I own a contract that gives me the right to sell the stock at 100. You can actually brag about that. And your friends and family would say, wow, how did you do that? Where'd you buy that from? I got to know how you do that. Why? Because this just protected the overall value of this person's position. Check this out. All the money that they lost on the stock going from 100 down to 60 is now in the options contract. The options intrinsic value alone is worth $40. Those are the bragging rights. $100 strike price, stock is at 60. That's real equity of $40. So what they lost on the stock is in the option contract. The option still has 5 months worth of time, so roughly about $1 worth of extrinsic value there. So what the investor bought for $6, it's actually worth around $41 at this point, since the stock went down and some time has passed. So did they lose money on the stock? Yes, but they made that money up on the option position. And so when you look at what happened here, yeah, if the stock went all the way to zero, they would lose all their money on the stock. But since they own the option, the right to sell the stock at 100, they still have the right to sell the stock at 100 as long as it happens before the 9-month window, which is the expiration date. The stock position still has unlimited profit potential, but the risk of the stock going to zero. In this case, 100 shares of the stock at 100 is a $10,000 risk. Okay. Now, options, as I mentioned before, will always have a better use of capital, better control over the risk. In this case, this type of position we used to ensure a stock holding while maintaining unlimited profit potential. In future web examples, we are going to talk about how to use options to speculate, how to hedge and insure, and how to really build out very significantly powerful directional and non-directional option strategies around these simple, basic concepts. Now, the end of this web series has come. If you have any questions about this web series, don't forget to shoot us an email at support@tradersarmy.com, and we'll be happy to answer any questions you have here. And if you still have questions about how options really work, do not worry. We have many other web series coming on options that'll help us get into all the details of how options work, and very specifically, how to trade them properly for any and all wealth buckets and income buckets. Thank you for being here. We'll see you next time at TradersArmy.com. Take care.